Today, we are going to understand credit risk mitigation in a very simple and intuitive way. Credit risk means the risk that the counterparty may default and fail to pay what they owe. Banks actively try to reduce this risk using three main methods: netting, collateral agreements, and downgrade triggers. Let us start with netting. Netting is a method where multiple transactions with the same counterparty are combined into a single net amount. Instead of looking at each transaction separately, the bank offsets positive and negative values. For example, suppose a bank has 4 transactions, plus 5 million, minus 7 million, plus 10 million, and minus 2 million. Without netting, the bank considers only positive exposures, so total exposure is 15 million. But with netting, we combine everything. 5 minus 7 plus 10 minus 2, which equals 6 million. So, netting reduces exposure from 15 million to just 6 million. This significantly lowers the risk. The key idea is that negative values represent amounts the bank owes, and these can offset what the counterparty owes. Now, let us move to collateral agreements. In this method, the counterparty provides assets like cash or securities as collateral. If the counterparty defaults, the bank keeps this collateral to recover losses. For example, if the exposure is 10 million and the counterparty has posted 7 million as collateral, then the bank's loss is only 3 million. So, collateral does not reduce exposure directly, but it reduces the loss if default happens. In technical terms, it reduces the loss given default. Next, we have downgrade triggers. These are clauses written into agreements. They are activated when the credit rating of the counterparty falls below a certain level. If this happens, the bank can either close out the transaction at market value or demand additional collateral. This protects the bank from situations where the counterparty's financial condition is getting worse. It acts as an early warning and protection mechanism. Now let us connect this to valuation of derivatives under credit risk. When we include credit risk, the value of a derivative decreases compared to a no-default scenario. If we assume DVA is 0, the value of the derivative today can be written as F equals F underscore ND minus 1 minus RR, multiplied by F underscore ND multiplied by the sum of Q underscore I. Here, F is the value with credit risk, F underscore ND is the value assuming no default, RR is the recovery rate, and Q underscore I represents default probabilities over time. Similarly, for a zero coupon bond, we have B equals B underscore ND minus 1 minus RR, multiplied by B underscore ND multiplied by the sum of Q underscore I. If we rearrange these equations, we get F divided by F underscore ND equals B divided by B underscore ND. This gives us a very important insight. A risky derivative behaves like a risky bond. The intuition is that credit risk effectively increases the discount rate applied to future cash flows. Instead of discounting at just the risk-free rate, we add a credit spread. So, the higher the credit risk, the higher the discount rate, and the lower the value today.